It's hard being a trucking company. Running regular routes or over the road is a time-consuming process. And it's a capital-intensive affair that wears down equipment and drivers. Wouldn't it be easier to just put it on a train or find other means of transportation? Well, it turns out that many trucking companies are doing just that by diversifying their business to include intermodal operations, as the money from their record profits over the past few quarters must be put to work. We examine this dynamic of trucking companies doing more than trucking in this episode of Loaded and Rolling. Good afternoon and welcome to Loaded and Rolling. I'm your host, Thomas Watson, enterprise trucking carrier expert here at FreightWaves, and we are doing it live out of Chattanooga, Tennessee. You might be asking yourself, what is intermodal? And how is this related to enterprise trucking? Do not fret, dear listener. It turns out that trucking plays a crucial role in intermodal operations, which is defined as moving freight by two or more modes of transportation. Often cargo is loaded on intermodal containers and moved between trucks, trains, and cargo ships before arriving at distribution centers to move further down the supply chain. All of this was made possible by the advent of the modern shipping container, created by a truck driver in the 1950s and now easily transferred from ship to truck to train, allowing our supply chain greater flexibility if speed is not a concern. A quick primer: according to the Wall Street Journal, intermodal accounts for nearly half of all Class 1 railroad traffic in North America and about a quarter of its revenues. It's a lucrative business and currently heavily consolidated. As FreightWaves reports, 4 railroads, BNSF Railway, CSX Transportation, Norfolk Southern Railway, and Union Pacific Railroad, control over 90% of the rail traffic in the nation. Also, there is little competition. According to the Surface Transportation Board, railroad rates fell by 45% in inflation-adjusted dollars from 1981 to 2019. Try saying that 12 times fast. This lack of competition, lucrative margins, and record profits by publicly traded trucking companies means that for many, rail and intermodal operations are becoming a major part of their business portfolio. Joining us today to do a deep dive into trucking's fascination with intermodal operations is FreightWaves' very own Mike Baudendistel. Before becoming an analyst and market expert at FreightWaves, Mike was a senior sell-side equity research analyst and covered publicly traded railroads, suppliers, manufacturers, and just about anything involving railroad equipment. He is a CFA charter holder and has over 15 years of experience in the freight transportation industry. Mike, welcome to the show.
And rolling means steel wheels rolling as well today.
Exactly. We are loaded and rolling on the rails. We're kicking it up. Looking at intermodal, and this is something I'm really interested in, publicly traded trucking companies like J.B. Hunt and Schneider, they're all planning to expand their offering. And so you think of these guys as over the road. Why would they want to go into something like rail and intermodal operations?
So those companies you mentioned, J.B. Hunt and Schneider, they've been in intermodal a long time. And, you might think of them as being over-the-road carriers. I think of them as being primarily intermodal companies. I guess for Schneider, it's about half and half for their revenue. But for a company like J.B. Hunt or Hub Group and Schneider, intermodal is really a core business for them. And, J.B. Hunt was really at the forefront of expanding the entire, domestic intermodal segment, through its partnership, starting in about 1989 with Burlington Northern Santa Fe. So those are really sort of intermodal, companies. Now, as for sort of why they would want to, continue to expand those businesses and why you have other trucking companies expanding into those areas, it's really a better business in a lot of ways than over-the-road trucking. It's defensible. It's, we can get into argument of whether or not, over-the-road trucking is a commodity or is it not a commodity. Intermodal service is not a commodity. I mean, you really have to have a certain amount of scale. You need to have the capabilities to coordinate all the different points of handling. It's a much more complicated process. And so, to use a Buffettism, there's a moat around the franchise there, and it's also has better returns on invested capital. You think of an domestic intermodal company, their main asset is the containers. They may do their own trucking, their own drayage. They may use some owner operators there, but the containers are less asset intensive than over the road equipment. So for all those reasons, it's a better business, and the companies that are publicly traded, get rewarded for their intermodal franchises with higher multiples of earnings.
I think that's interesting to think about. You think of trailers over the road. They're going to break down, tires, all these issues. You have the rail containers. One thing I read was that some of these rail companies do not have their own containers. And so is that when we talk about defensibility, if you're a trucking company in intermodal, that kind of allows you to kind of corner the market, so to speak, right?
Yeah, so the domestic intermodal companies have historically been kind of the marketing arm for intermodal. So at least for the U.S. carriers, in Canada, they do things differently. But really, the ownership of the containers, there's some pools that are shared, but also these big domestic intermodal companies have their own very large fleets of containers. And really, if you think about what capacity is out there, it's basically the number of, let's say, domestic containers and how quickly those containers are being turned. So, we hear J.B. Hunt talk about adding 40,000 containers in the next 3 to 5 years, with commensurate increases in terminal and investments and chassis and those things. I mean, that speaks to an increase in domestic intermodal capacity in the next few years.
And looking at that, especially with the plain domestic intermodal by JB Hunt, Hub Group, and Schneider, is there kind of like a differentiation? Would you want to be involved in international versus domestic, or are there any kind of different equipment involved?
So there are really two different segments. Those companies that we're talking about participate in the domestic intermodal side of the equation. And so they're moving primarily 53-foot containers. So that's domestic equipment that does not leave North America. The international side of intermodal is between the railroad and the steamship company, and those tend to be multi-year agreements. And so do think of those as being two different segments. Really over the last year, domestic volume has risen, while international volume has fallen. I mean, domestic had kind of a U-shaped last year, but the volumes held up much better than international intermodal. And it really doesn't matter whether the goods inside those containers are imports or not. It's really the segmentation is by the equipment. Are we moving domestic equipment or international equipment that goes across seas? So really the companies that we're talking about here participate in the domestic side of the equation.
Once it definitely arrives in. And I'm hearing a lot of pressure, especially regarding environmental social governance or ESG initiatives, and it's becoming extremely popular as a way to offset carbon emissions. Do you think this is a way as well for trucking companies to try and not only expand market share, but also try to get ahead of these changing, investor expectations on what you're doing for the environment?
Yeah, that's been a big investment theme for a long time. I remember when I was at Stiefel, there were lots of funds that wanted ideas specifically that were green ideas. Like they even put it in like a green fund, and some of those portfolios added companies like a JB Hunt or a Hub Group, because intermodal is more fuel efficient than the highway, by quite a large, margin. Some say it's 4 times more fuel efficient. It also has about half the fuel surcharge, so it just burns less fuel. I mean, it's a more efficient way to move goods over the surface of the earth than than truckload. And maybe the big sort of variable going forward is, are we going to go to a situation where we need to have scope 3 carbon emissions, where you're not just looking at the carbon that your particular business emits, but throughout the supply chain, and that would include moving goods. Because I think the idea with carbon reduction is we want companies to locate plants and consider their supply chain holistically, and not just say, well, we're transferring these goods thousands of miles. That's not that's what something the railroad does or the trucking company does. whereas really that's should be tied to the shipper also. So if that comes into play and companies start to get audited based on their carbon, that could have a big impact with companies looking to shift to intermodal. I think to this point, most of the motivation that shippers have for using intermodal is strictly the cost savings involved. You tend to think of intermodal as being 10 to 15% cheaper than truckload.
That's an interesting point because, earlier in the pandemic, we had a lot of backlogs along the rail. We had issues with containers, there were delays in services. And so, coming out of the pandemic, we saw that shift from intermodal to truckload. Have you noticed, at least in any of your research or what you're hearing, does it look like now we're starting to see a recovery in intermodal now that fuel surcharges and other prices, and we're kind of getting a little bit less hectic compared to 2021 all gas no brakes levels?
Yeah, we're seeing that a couple different ways. I mean, one of the ways that's really evident is just go into Sonar and compare the domestic intermodal volume. And one of the advantages of Sonar is we break out that domestic intermodal volume versus international, which you really see that they're two different segments when you look at those segments individually. And the domestic intermodal volume here the last, let's say, 2 months has really outperformed domestic truckload volume. You see, domestic truckload volume, as we've talked at length about on Freight Waves, has fallen, greatly. I mean, well over 10%. Domestic intermodal has hung in there, and so you see it, in the data, and then you also see it from these companies, reporting, earnings and saying that truckload conversions are in intermodal units have been very strong. Just listened to Hub Group the other day. They reported, I think, on Thursday afternoon, and they said it's the best conversion that they've seen in some time. And there's a lot of different factors that go into that. You mentioned fuel, diesel prices going through the roof right now, but it's not just that. It's the intermodal service is maybe not at optimal levels like everyone would like to see, but it's a lot better than it was during the third quarter into the fourth quarter of last year. And then you have inventories that are rising, that are in some cases there's too much inventory, in other cases there's not enough, depending on what product line we're talking about. But no longer do we have intermodal or inventories that are so narrow that you have to have the need for speed is paramount, where now shippers are more willing to sort of wait that extra sort of truckload plus a day or truckload plus maybe even a couple days.
That was always interesting. When I was a broker, you do truckload or you'd put it on the rail, and you really had to figure out how soon do you need it, because like you said with rail, it can take a little bit of time for it to process through the network. Diving on this fuel, I've heard a few things, especially I think maybe JB Hunt and Schneider, a few of these guys are talking about fuel surcharges are going up, and it's also trouble finding drivers. When we're buying, I think we actually have a price, diesel truck stop price per gallon graphic we can throw up as well. Driver shortages, having trouble finding drivers, is that kind of why we're seeing like JB Hunt getting 10,000 more containers over the course of a year, or these big movements? Is that also a contributing factor, fuel and drivers?
Yeah, I mean, it's certainly, if there's shortage of trucking capacity, that this is one way to move goods. You do have to be a little bit cautious in terms of saying, well, intermodal is just going to be the relief valve for trucking. I mean, it doesn't work that way, because intermodal is so concentrated in the dense corridors. So if shortage of truck drivers, shortage of trucking equipment, it doesn't help you move a lot of freight that's time sensitive or that's in short haul. I mean, it's just most of the freight is never going to move intermodal. Intermodal is really heavily concentrated in these dense corridors that are anchored by big cities. Lanes like LA to Chicago, LA to Dallas, LA to Atlanta, Chicago to Atlanta. I mean, it's we could go through the whole list of 10 or 11 in 30 seconds. But really, it's not really that sort of relief valve. But I do think higher fuel prices, can cause some shippers to sort of jump the fence and sort of convert, try using intermodal. It is a risk when shippers that have always used truckload are going to try to use intermodal. They're not really sure what the service levels are going to be. They don't want to look bad in front of their boss if the goods don't get there on time. So some can be kind of reluctant, but sort of once they do it, they sort of get used to it. It does tend to be pretty sticky, unless they're is really time sensitive. Goods are really time sensitive, and then it may shift temporarily to truckload.
That was interesting to see. That the graphic we threw up earlier was literally 534 per gallon versus a few years prior we were literally at 359 per gallon. So it was extremely crazy amount of fuel difference. And talked about earlier earnings. Trucking companies had record Q1 earnings for most of them across the board that I've reported so far. Is this a form? We're seeing this movement in intermodal, LTL, last mile. I'm surprised they wouldn't just put it in trucking. Is this because they need to put their money to work? Is this maybe a redeployment and reinvestment in this capital for future downturns?
I think they're investing in everything except regular truckload, just because truckload is the least differentiated business. It's the one that doesn't have the barriers to entry. It's the one that if we're all right that there's going to be a trucking bloodbath, that's the one that's going to be hurt the worst. I mean, LTL is a much more concentrated business, so that's much more defensible. Intermodal is some of these others like the brokerage is asset light. So even though there's not a lot of barriers to entry in brokerage, you're still not taking a lot of capital risk. Over the road trucking is kind of the worst of all worlds. It can be a commodity business and it's extremely capital intensive, and you have to deal with all these regulations and there's liabilities if something goes wrong. So over the road trucking is just the least attractive for a lot of companies putting capital to work in freight transportation.
That's what I was curious about because, looking at especially, owning the containers, owning the assets, you're making these redeployments of capital. I didn't really think that a lot of people, especially these largest trucking companies, don't understand that now they're moving away from trucking. I guess that's just the strangest thing for me to wrap my head around as you become a large billion-dollar publicly traded trucking company, and the first thing you do when you finally get a lot of money is, let's get out of trucking. Is that almost the trend for most of them when they reach a certain level?
Yeah, I think diversification is important, and having multiple asset streams is important, and it makes a lot of sense from an investment standpoint that you don't want to be in the worst business. So I think we'll continue to see that, and once those trucking companies reach a certain level, then you do have the scale advantages, and being in different segments, there's a certain amount of synergy there where your asset light or brokerage division can look at a load and say, well, should this the shipper thought this was going to be a truckload move, but look, there's excess container capacity in this particular lane, and it's a dense intermodal lane, and it's not all that time sensitive. So if you can work across modes, I think there's some synergy there.
So it's like you're moving up and down the supply chain versus, so instead of being a middle mile play, now let's go up to the first mile, the last mile, and then we're going to have that defensibility by broadening our depth instead of how wide we are in this truckload segment almost.
Yeah, I think that's right. I mean, it's particularly when you're dealing with huge, shippers, and you think about, who some of these big, customers are that are moving, intermodal. I mean, they're also moving, truckload. They also have some sort of one-off, shipments that, they can use a brokerage, services. So like a lot of the big intermodal, shippers, it would be a lot of consumer goods, companies like, Unilever or General Mills, and then also a lot of retailers. So you think of the big retailers like Walmart, Target, Home Depot, et cetera. Those are all big intermodal companies. In addition to some transportation companies like UPS is one of the biggest intermodal shippers. And so it's just these companies that once they get to a certain size, they can help these companies with whatever sort of transportation service they need is pretty valuable.
I wanted to circle back. We're talking about owning the assets like containers. I was always curious as to why, when it comes to, if I'm a rail company executive like BNSF or Norfolk Southern, why would I not want to have my own assets, or why would it make more sense to partner with a trucking company or a carrier to provide me with assets? Is there like a risk reward to that kind of decision?
Well, mostly because the containers are, some of them are in shared pools, and so the containers will go from one railroad to the other. So kind of like how chassis are in pools that, once the piece of equipment goes on another railroad, you don't want it to be, not utilized. And so there are some containers that are shared, but then, also it's just historically the domestic intermodal industry grew up with these companies, serving as the marketing arm for intermodal. I mean, Canada is a little different because Canada is mostly that international intermodal segment, and so it's mostly the railroads dealing directly with the container ship lines. But in the U.S., domestic is the largest segment, and so those do tend to be on kind of 1-year contracts. And these companies that are the truckload based intermodal companies, they can arrange to have the full intermodal package, the drayage on either end, consolidating the billing, consolidating any damage claims, all of those things sort of act as the marketing arm and the customer service arm.
And I was, when we were mentioning earlier, we actually have a graphic talking about volumes in terms of, you talked about earlier that rail is highly concentrated in certain areas, Los Angeles, Seattle, we're looking at Elizabeth, Norfolk. Is that something where we're talking about on the West Coast versus East Coast and that East Coast ports, and there's some labor negotiations coming up? Is there the potential for intermodal to gain even more ground because dealing with strikes, dealing with all this other stuff out of some of these ports? Is that a potential play due to either disruptions or costs?
Yeah, I think it is. Really, the last several years, the big trend has been the East Coast ports have taken share from the West Coast ports. And the reason for that is the per mile cost to transport a box is cheaper on the water than it is on the surface. And most of the population, let's say 45-50% of the US population is on the Eastern time zone. So if you can move the box closer to where it ultimately needs to go on the water, that's cheaper than bringing it in through LA, taking it all the way to Chicago or New York. So that's been kind of the big trend. As a result of that, there's been all these investments on the East Coast, things like huge expansion of the various ports on the East Coast, all up and down the East Coast has been tremendous. Raising the Bayonne Bridge in the New York area, all of those type of investments. And that had been the trend up until the pandemic. And the pandemic, with all the supply chain issues, all of a sudden speed got to be more important. And so you saw a share shift back to the West Coast because it's faster to have what they call the land bridge option, which is bring it through LA, take it intermodal to Chicago or Dallas and onward. Because the pandemic caused more time sensitivity, that's where the West Coast ports gain share. Going forward, it's a little bit of a question. I mean, there was so much, share gained by the West Coast ports that, caused all those congestions and all the container ship lines, queued up, near the San Pedro Bay, et cetera. Going forward, we'll see what happens. This summer, the ILWU set to have, new contract rolling over, July 1st. There might be a work stoppage. There might be a work slowdown. We don't know. Even if it's a slowdown, that would be pretty disruptive. It's a thesis of some that there's going to be more movements coming in through the East Coast to avoid that, or there's already been a rerouting of shipments. And so that graphic that you had up, compared to this time a year ago, all of those West Coast locations are all in the red, volume that's below where it was a year ago. All those East Coast locations, or most of them at least, you see, Elizabeth, Norfolk, and Charleston all up nicely, LA, Seattle, et cetera, all down. So that may be because of the congestion at the West Coast where those ships, queued up, or it also may be, a lot of shippers just want to get those goods into the U.S. From there, they'll figure out a way to get it to the final, destination. But I think the long-term trend holds that the East Coast ports are going to gain share from the West Coast ports, but it will move, back and forth. There's also the potential that all these, shutdowns in China are going to make goods more time sensitive because they're going to be delayed, and that's going to encourage more shipping through the West Coast. Although some of those goods might just spoil. They'll get here so late. You'll have the Halloween, costumes in December, again. So there's all those issues, but we'll see. A lot of moving parts there.
A lot to look forward to. Mike, I really appreciate you having you on as well. You've got the stock out talking about CPG, as well as you do a lot of commentary regarding the intermodal from your experience. Thank you so much for coming on. I'm going to have you on again. We're going to talk about CPG because for a lot of people, I don't think they understand just how important it plays for the trucking industry.
Yeah, happy to do that. Good to see you.
Thank you, sir. Don't touch that internet dial. We are basically coming to a close here on our wonderful program today, but stay tuned. Every Tuesday now is the new time at 1 p.m. Eastern if you want to see us do it live. Otherwise, check us out on Apple, Spotify, and any other streaming service or tv.freightwaves.com. That's it for today. I'm your host, Thomas Wasson. Join us next week. We will do it live.